You're still with Dr. Adebayo in Business AS level. I want us to quickly look up to a question, and the question is about the question. I'm going to read the question, then work it together. They said, explain how reducing receivables may not lead to an increase in the value of working capital for the toy company. So there's trade receivables and there's working capital. For working capital, the formula for working capital is current assets minus current liability. Now, when we look at trade receivables simply means our credit customers, right? So if a business reduces its credit customers, I think I have to illustrate this on the screen. So hold on, please. So we have working capital. We have working capital, right?
Yeah.
Working capital, which is current assets minus current liabilities, right? Current liabilities. This is working capital. Now, for current assets, we're simply talking about the resources owned by the business that can be easily turned to cash within a year. That is current asset. Examples of current assets are cash, debtors, which is the same as receivables. Receivables. Then we have bank. But in this case, we have cash and debtor. So let's talk about cash and debtor here, right? Yeah. Now, the question says, explain how reducing receivables. How reducing receivables would not lead to an increase in working capital. Remember, working capital is current asset minus current liability, yes, right? So if you are reducing your debtors, how will reducing your debtors does not reflect in an increase in your working capital? That is the question. You've reduced your debtor, which means now you have more cash. Your cash has increased, yes or no? Reducing your debtor means your cash has increased. Yeah. But if your cash is increasing, why is your working capital not increasing? That is the question. So now let's go back to it this way. For our current assets, cash and debtor are part of the items in the current asset, yes or no? But they have inverse relationship in this situation. Really? If debtors is reducing, cash would increase. Do you get what I'm saying? Yeah. If your debtor, let's write it with another color. So let's say debtor, we have debtor and we have cash. That is what we have here. But the business is trying to reduce its debtor so that it can have more cash. Yes or no? Yeah. So now in this case, the debtors has reduced. Cash has increased. But both situations would not increase the working capital. And why is it not increasing the working capital? It's not increasing the working capital because, yes, we have more cash, but debtors has reduced as much as cash has increased. Nothing changes. Yeah. Yes, you are going to have cash available, but your debtors has reduced because both of them lead to current assets. So in this case, your cash has increased, your current asset, and your debtors has also reduced through the current asset. So the debtor has reduced as much as the cash has increased. So they're still going to be the same. So if your debtor here, let's assume now, use figures so that we can understand the point, right? So let's assume we have current assets. We say our current assets, let's say we have debtors to be 500, right? Now debtors are our cash. Our debtors has reduced from 500 because our debtors has reduced from 500. Now, no, we don't have debtors anymore. Now we have cash of 500. So debtors has reduced as the same as cash. Do you get it here? So when you have no debtors, that means minus 500 will be plus, here will be minus 500, and this is 0 already. This will be minus 500 and this will be plus 500 because cash would increase while debtor would reduce. Do you understand? So a reduction in debtor would not significantly increase your working capital because if your debtor is reducing, it means your cash is increasing. But the debtors has reduced as much as the cash has increased. So do you get what I'm saying here?
So the working capital won't change.
It won't change. The working capital will remain the same because here, if debtor is 500, cash was 0. Yeah. Now your debtor has reduced by 500, your cash has increased by 500. Nothing changes.
Yeah.
Cash increased, debtor reduces. We need both of them for working capital, because working capital is current asset minus current liability. Do you see why it's not going to increase now?
Yeah.
So, but it is an advantage because now the business will have enough cash to run its activities.
Yeah, to pay its bills.
Do you understand?
Yeah.
So that's how current asset an increase in debt, an increase in cash with a reduction in debtor would not change the working capital. The working capital is there.
Yeah.
When you have more cash, you have more working capital. Yes. But the point is, you won't be able, it will not increase because the working capital is not just dependent on cash, it's also dependent on debtor. And in this case, our debtor, like I just said earlier, if your debtor is on 500, your cash is 0. Now, if all your debtors paid, it means minus 500 plus 500 for cash, minus 500 for debtor plus 500 for cash. So your working capital remains the same, but now you have cash instead of debtors. So you're going to have more liquid.
Yeah.
Unlike when you have more debtors. When your business has more debtors, it's going to be illiquid. It's going to be shorting on cash. But the situation now is that your debtor has reduced. Because your debtors has reduced, now you have more cash. But your working capital remains the same. And what is the formula for working capital? It is current asset minus current liability. The only time your working capital would increase if your current liability is reducing. Because if your current liability is reducing, it simply means your working capital would increase. Does it make sense here?
Yeah.
But if any item changes from your current assets, it does not significantly change the working capital. The working capital needs both the current asset and current liability to change for it to change, not just items in the current asset. I think it's clear now, and I believe the audience also understand what I was explaining. It's about cash and debtor leading to increase or reduction or constant working capital. The working capital will remain constant even if your debtor reduces, because your debtor reducing means cash has been paid. So your debtor would reduce as much as your cash has increased, because both of them have inverse relationship. So the working capital remains the same. The only time the working capital will change is when the current asset or the current liability changes. I made Dr. Adebayo. See you again.